Have you ever noticed something strange about investing? The biggest losses rarely happen when people are terrified. They usually happen when everyone feels safe. That sounds backwards, doesn't it? Most people think risk is something obvious. They imagine a crashing stock market, scary headlines, or red numbers flashing across a screen. But Howard Marks has spent decades teaching that real risk is much harder to see. In fact, the most dangerous risks are often invisible until it's too late. Think about driving on a rainy night. Most people slow down because they know the conditions are dangerous. Now imagine driving on a bright, sunny afternoon. The roads are clear, visibility is perfect, and everyone feels confident. Ironically, that's often when people become careless. They speed up, glance at their phones, or stop paying attention. Investing works the same way. Risk isn't just about what the market is doing, it's about how people behave. One of Howard Marks' most powerful lessons is that risk is not the same as volatility. A stock can swing wildly in price and still become a fantastic long-term investment. On the other hand, a stock that barely moves can be incredibly risky if investors have convinced themselves that nothing can go wrong. That's the misunderstanding. People confuse comfort with safety. During market booms, optimism spreads like wildfire. Friends start talking about easy money. Financial news becomes overwhelmingly positive. Investors begin believing that this time is different. Prices keep rising, confidence keeps growing, and caution quietly disappears. Ironically, that's often when risk is at its highest. Not because the businesses suddenly became worse, but because expectations became unrealistic. Howard Marks reminds us that investing isn't about certainty, it's about probabilities. Imagine flipping a coin that's weighted to land on heads 60% of the time. You'd probably make money over hundreds of flips, but you could still lose 5 flips in a row. That doesn't mean your decision was wrong. It simply means uncertainty is part of the game. Investing works exactly like that. A great investment can lose money. A terrible investment can make money. The outcome alone doesn't tell you whether the decision was smart. That's a lesson many investors never learn. Our brains naturally judge decisions by results. If someone doubles their money buying a wildly speculative stock, we assume they were brilliant. If another investor carefully researched a company but temporarily lost money, we think they made a mistake. Howard Marks would argue the opposite. He believes intelligent investing is about making consistently good decisions, even when the short-term outcome is disappointing. Over time, good decisions tend to win. Luck fades, discipline remains. This also explains why predicting markets is so difficult. Nobody can consistently know what will happen tomorrow, next month, or even next year. Instead of trying to predict the future, successful investors prepare for multiple possible futures. That's a completely different mindset. They ask questions like, what if I'm wrong? Am I being paid enough for this risk? And am I buying because the investment is attractive or because everyone else seems excited? Those simple questions can save investors from costly mistakes. Perhaps the biggest misunderstanding about risk is believing it can be eliminated. It can't. Every investment carries uncertainty. The goal isn't to avoid risk completely. The goal is to understand it, respect it, and make decisions that leave the odds in your favor. Howard Marks teaches us that the greatest investors aren't fearless. They're thoughtful. They know that confidence without humility can be incredibly expensive. So the next time someone tells you an investment is completely safe, pause for a moment. The absence of fear doesn't mean the absence of risk. Sometimes it means the opposite. If you enjoy exploring timeless investing wisdom and the psychology behind building lasting wealth, consider subscribing. Leave a like if this changed the way you think about risk, and share this with someone who believes investing is only about chasing the highest returns. Sometimes the best investment lesson isn't about making more money, it's about avoiding the mistakes that quietly destroy it.